Hey, so do you ever wish you could jump into a huge trading opportunity? You know professional traders are just crushing, but you're afraid to do so because you think it's too risky for you. Well, there are some trades that appear risky for you, but actually aren't. And staying away from these potentially game-changing trades may be holding you back from becoming your best trader. In this video, Lance Breitstein, #1 prop trader in back-to-back years, helps you flip the script and use volatility to your advantage. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. We hope you agree. This is the #1 YouTube channel to help you grow your trading account.
Hi everyone, I'm Lance Breitstein and you can follow me on Twitter at @TheOneLanceB. Today I'll be discussing how volatility is not risk, a very important concept in trading that came up this month. So look, I get it, volatility is scary. So let me ask you, what is the fastest you have ever seen a stock move? Have you ever seen a stock truly waterfall? Or have you ever been caught long before in one of those moves? I can remember a couple in my career. I even remember this time, this stock Arena Pharmaceuticals really panicked. There's even a famous YouTube video of a retail trader that was trading it and just freaking out as all the prices just started to skip before the eye could even see. Can you feel that pit in your stomach? That sickening feeling as that wealth transfer is just occurring at a dizzying rate and you're on the wrong side of it? That feeling of fear and panic, while it might not seem like it, for an experienced trader, that feeling can actually become the feeling of opportunity. And I'm going to tell you why. So if you don't believe me, first let me reference one of my favorites. The great Uncle Warren Buffett always knows best. So in the 2019 Berkshire Conference, he said, volatility is not a measure of risk. And he gives this amazing story that I'd like to relay to you, because even though it's on a different time frame and a different type of investment, it totally relates to what we do as traders. What Warren told is a story about buying farmland in the 1980s. At the time, it was going for $2,000 an acre, and then there was a crash in the price of farmland. The volatility went to the roof, and a stable asset like land went from $2,000 an acre to $600 an acre. So that volatility at the time, so many people perceived as risky. People are saying, oh man, when will prices bottom? Where will they bottom? Will it ever come back? But it's during those times that it's actually the safest time to act. And that's exactly what Warren did, right? And because so many people are scared, it often is when it really offers some of the best risk reward. Let me even bring this back to the trading world now. Sometimes it is safest to be risky. That's a total paradox, and this was actually one of the favorite sayings from my trainer that taught me how to trade. And so how is it possible that sometimes it could be safest to be risky? Well, let's bring this back to poker analogies, which I always love to use. If you're in a tournament, it's near certain that you're going to lose if at some point you're not going all in or going big on the big hands. In fact, the absolute safest thing you can do in poker to maximize your odds of winning is that you go all in when you have the nuts or really push the hands that you're really doing well in. In a tourney, you can't afford to limp in with the really good hands. And so in trading, some traders take comfort in trading the boring, not in play stocks. They know that they can really control their risk. It's never going to get away from them. But trading crappy tickers is actually the riskiest thing you can do because those are the tickers with no edge. And so here's the thing, is if you're trading tickers with no edge and negative expected value, it is guaranteed you will not succeed at this job. And let me repeat that. If you're trading tickers with no edge, it is a 100% certainty that in the long run, you will not make it. You only need to be trading stocks with edge, or as I call them, the broken slot machines. And doing that is actually the safest thing you can do because the odds are in your favor if you trade them properly. So sometimes, like in investing, the safest time to buy stocks speaks to like when it's peak uncertainty and risk, like in 2008 or 2020. And so often in day trading world, that holds true as well. Remember, the comfort zone is not your friend. Boring, liquid, slow-moving stocks might make it easy to calculate your risk with total certainty, but the biggest and often the best ops for traders come during times of most volatility and least comfort. This is as true as it is for long-term traders like Buffett as it is true for us. To get involved in the good stuff, you need to gradually and conservatively wade into the deep end. And so this topic really hits center stage, as in the month of March, that banking crisis led to a huge amount of volatility throughout the last couple weeks. And so I got a question that was really great. Lance, during the SVB banking crisis, was it better to trade a basket of banks or stick to the one or two most likely to bounce? So really this resulted in me sending out a firm-wide email addressing this. My answer to this really great question was this. The best place to allocate risk on Friday was the most extremely sold off and panicked names, FRC, PACW, WAL, and not because they were likely to go up the most, but because in my view, they offered the best expected value. The less volatile megacap banks and ETFs offer liquidity and comfort, but in my view, they also offered less positive expected value. Some traders might stay away from the best names because in volatility terms, they seemingly are the riskiest. Now this leads to a key lesson for traders. In day trader world, volatility is not risk. A trade can have negative expected value, but in terms of risk, you might be able to cut your losses within 5 cents or 10 cents. Some traders consider that safe, but taking on negative expected value is actually the riskiest action you can take. In fact, you're guaranteed to fail and lose money. At the other extreme, a stock might be moving $5, $10 in a second. It might have a really wide spread or fresh news. But paradoxically, despite that volatility, that stock, if it has strong positive EV, is actually one of the safest bets you can make because there's actual edge and positive expectancy. So what are the implications of all this? Let's be clear here. This does not mean you want to blindly go nuts in the craziest stocks and forget all about your playbook. What I hope you take from this is objectively assess the tickers and strategies you're trading to make sure you're getting involved in the spots with the highest expected value. Additionally, through sizing, you can control your risk and get involved in situations at an acceptable level of risk. And I think that's a key part that people miss. When I've had discussions about this topic with others, they say, oh, what about halt risk? What about this? What about that? And it's true. There is real halt risk in some of these names, but the key part is you need to handicap that risk into the overall expected value equation. And then knowing that that risk is out there, you simply need to size accordingly. But if it's a positive expected value play and it's a really good expected value, that's really where you need to be. So here's my challenge to you. Ask yourself, is there any part of trading that scares you, but you think might offer opportunity or you could add to your playbook? Many traders fear pre-market or after hours, or they fear the whiplash of earnings releases or waterfall panics. I want you to start first by observing these situations. Record your screen and then slow it down and replay it, and slowly work up to full speed. What often seems crazy or moving so fast that you can't even follow it, once you get practice, it's not as scary as you think. And then develop a basic level strategy around these. And then remember, you can always dip your toe in for just one share, as silly as it sounds. So many traders get involved for the size they're used to and rip up a lot of money that they don't need to. You just want to slowly grow your risk and your comfort only after measuring success while continuing to refine these strategies. Once we get over our fears and nothing is off limits to us as a trader, that's when a whole world of areas to develop out our playbook really opens up to us, particularly in spots where others are scared to go. So volatility is opportunity. I promise you that. Every great trader thrives when the market is more volatile. And so what about trading halts and the uncertainty and the unknown? What about when the spread blows out? Look, sometimes those fears are totally rational and there's a kernel of truth to them, but it's also those fears that directly lead to less competition in those plays. And that less competition often leads to less efficient markets and therefore more edge and opportunity. The advantage of intraday traders is that we are quick and nimble and can change our mind on a dime. Hedge funds and the big players are often running models and strategies that prohibit them from acting as quick as us, or they just simply have a chain of command that moves too slow. Or sometimes these opportunities exist so quickly that they just can't get the size for it to be meaningful to them. Their inability to go in these areas is your opportunity. But remember, just because something is volatile does not necessarily mean it has positive expected value. Do not conflate that concept. Being long SVB or a couple weeks ago from 140 bucks, most certainly that was volatile, but it was not positive expected value. But volatility often does present opportunity. It's your job to find those opportunities, then structure the trades in a way where there's proven edge for you. As the old saying goes, scared money don't make money. While that's been cheekily said on trading floors around the world, there is truth to it, because without prudently accepting risk, one can never capture the reward. To read the full tweet and discussion that followed online, follow me on Twitter at @TheOneLanceB, and feel free to ask questions or contribute from there. Thank you so much.
So do you want to learn more actionable trading ideas that you can implement starting tomorrow from Lance? Then watch the video from Lance, Top 5 Worst Trading Myths, Crushing Your Profitability, appearing on your screen right now.